Hi, Gabriel, Josiah here. Are you ready to sharpen your understanding of the equity ratio, a cornerstone metric in financial analysis? Whether you're a student preparing for exams or a seasoned accountant seeking practical insights to excel in your role, this video is for you. Join me as we decode the equity ratio, its formula, meaning, implications, and real-world application, as we'll be using an example to address the equity ratio practically, so you can ace your exams and elevate your workplace analysis. Let's dive in as I share my screen, as is our custom, and let's look briefly into this fantastic metric called the equity ratio. All right, I've gone mini as usual, and let's look at the equity ratio. It's also known as proprietary ratio. Proprietary means the owners of the business. So equity ratio talks about ordinary shareholders' funds, equity holders' funds, proprietors of the business, owners of the business ratio. It's a financial metric that measures the proportion of the company's total assets that are financed by shareholders' equity. Very simple. It indicates the level of financial leverage a company is using and reflects the degree to which a company is reliant on equity as a source of financing. A higher equity ratio suggests a lower reliance on debt and greater financial stability. So the formula is clear. We want to get the percentage of the total equity in relation to total assets, where total equity includes shareholders' equity, common and preference stock, retained earnings, reserves, anything attributable to the shareholders' funds is our numerator. While total asset refers to the total resources owned by the company, current and non-current. Very, very important. So let's dive into the example we'll be using as usual. The company shall do Nigeria PLC, and we'll pick our total equity from the SFP, our total preference or total shareholders funds for the end of the year, 31st December 2020, which is what we'll use, is 1 billion naira. So we take that. As usual, if you have your calculator, follow me as we do these simple calculations. We have it as 1 billion naira for shareholders funds. Okay, so let's go get our total assets, which includes our current and non-current assets. So we have our current assets for our non-current assets of 550 million. And we have our non-current assets as a total of 1,045 million naira. Okay, so we have our total assets as 1,595 million naira. So we take that and we'll post here in our Excel to calculate our equity from proprietary ratio. Okay, so how much is that? Let's calculate that. So we have our total equity divided by our total assets, and is 63%. 63%. So our total equity is 63% of our total assets. So what does this mean? What does this mean? The equity ratio provides insight into the company's capital structure and financial health. So a higher ratio, looking at from 50 upwards, indicates a significant portion of the company's assets is funded by equity, implying lower financial risk. So in this case, we have 63%, which is high, indicates lower financial risk for shareholder 2 Nigeria PLC. Conversely, a low ratio may indicate higher leverage and reliance on debt financing, like we saw in the debt ratio. You can go back to the video on debt ratio calculation to see the relationship between the debt and the total asset of the company. The video was done on that previously. You can look at that based on the calculated ratio on this same company Charlotte between Nigeria PLC. So a low ratio indicates a higher leverage and reliance on debt financing, while the implication of a high equity ratio is often viewed favorably from investors and creditors, as it indicates a more conservative capital structure and lower financial risk. This can lead to greater stability in terms of economic downturns because equity holders have a greater share. This is good for the owners of the business. While conversely, a low equity ratio may suggest higher financial risk where debt holders or external providers of capital have a chunk of the company at their grip. Increased vulnerability to insolvency, liquidation, especially if the company faces cash flow challenges. This is very critical. The cause and effect of a high equity ratio is strong retained earnings, low levels of debt, or recent equity financing or injection of funds from owners of the business to the business. And the effect is increased financial stability, lower risk of bankruptcy, and a more favorable credit rating. While the causes of a low equity ratio indicates or shows high levels of debt financing, external debt financing, operational losses, reducing equity, or aggressive growth strategies funded through borrowings. The effects is clear: increased financial risk, potential difficulty in meeting obligations, and a greater likelihood of experiencing liquidity issues. So, as chartered accountants, we need to avoid a situation where the equity of the business or this equity ratio is low. It must be avoided at all costs. So, in conclusion, the equity ratio is a key indicator of a company's financial structure, revealing the balance between debt and equity financing. By accessing the proportion of total equity to total assets, stakeholders can evaluate a company's reliance on shareholder financing and its overall financial risk. So balance is still the same word that is being reiterated here, balance. So balancing equity ratio or having a higher equity ratio is much more favorable and essential for long-term sustainability and for fostering investor and creditor confidence. This is very, very important. All right, that wraps up our deep dive into the equity ratio. Understanding this vital metric can set you apart in both your professional exams and workplace applications. Don't forget, a high equity ratio signifies or signals financial stability, while a low one can indicate increased risk. But every scenario has its story depending on the industry. If you found this video valuable, give it a thumbs up. Share it with your network. Let me know if you have questions, contributions, comments in the comment section. And hit the subscribe button for more actionable insights tailored for your accounting or finance practice. Let's keep growing together. See you in the next one. And until then, bye for now.